Okay, in this video, we're going to talk about ratio trading. The top 1% of traders in the entire world use ratio trading as the basis for their fortunes. And I'm going to reveal to you some of the secrets that they use in this video and in the next two videos. And then we're going to conclude this workshop. So let's get right into it. Ratio trading at its basic core is taking two different or related financial instruments and then trading against each other. It's not the same thing as spread trading that you may have heard about. It's actually a relatively new phenomenon. Started probably around 2006 at its earliest. So it's only been around a few years, and very few traders really understand it or know about it. And the ones that do know about it really aren't talking about it. It's a new phenomenon because of the invention, creation of new financial instruments in the market. And after I reveal to you, you might think it's quite simple and quite obvious, but believe me, there are only like 1% of all the traders using this, and it's going to blow your mind. Here's the Dow Industrial Average, and the ETF for that is the diamonds. So let's go over to the diamonds because you can't trade the cash index unless you buy, of course, every share in the Dow 30. The diamonds make it a lot easier to trade the Dow. All you do is buy a single index, and you're pretty much good to go. So here are the diamonds, and just like any other market, it's going to have its ups and downs, right? It's going to be, it's going to be in rally mode, and then at other times in sideways consolidation mode. Now, for the most part, markets only trade in trends, really identifiable trends, about 10% of the time. They're only going to trade in a trend about 10% of the time. The rest of the time, they're just going to be going sideways in a consolidation mode. If you take a look at this chart going all the way back on a monthly basis, you'll see that, there's a lot of consolidation areas in here, and there's a couple of really nice trends here, but for the most part, on a monthly basis, the market is really working in a trend. So each month, the market is going to trade in a specific range. Let's take this month back here in June of 2006. We had a low of about 92 and a high of about 97. Well, there were profit opportunities in that month. So each of these months could be a different trading opportunity. Now, some months, obviously, the market declined dramatically. In other months, the market advanced dramatically. But the fact is that each of those 30-day periods was a profitable opportunity for the most part. Now, we had a couple of months here, keeping in our theory of low volatility, that the months traded in extremely narrow ranges. And that was also a really good clue that the market was going to go higher. Remember, that's one of the clues that we look for when volatility subsides. When we see those shorter range bars, that means volatility is subsiding, and in fact, the market is probably going to be going higher. So how do we trade off of the information that we just made here, that in fact there are monthly ranges that we can probably profit from? There are some wide-ranging bars, some small-ranging bars, so profit opportunities are a bit more limited. However, what we try to do, of course, is we want to take advantage of those monthly opportunities to generate some profits. Well, if you take a look at just about any single chart in the market, there's diamonds. We could go over and take a look at the Qs. You can see a tremendous amount of sideways action there with one big rally here for the last couple of years. Let's take a look at the SPY. The major markets all have, times in which they rally, times in which they go sideways. It's particularly tough to trade these consolidation periods. For example, between August here and October in 2011, it was a tough time to trade unless you were extremely nimble. The market seemed to be up and down almost every other day. In the end, of course, we were just in a consolidation period, which the market does about 90% of the time, just goes sideways. The rest of the time, it trends. The 10% of the time it trends. Now, how do we determine, when to make our moves? Well, we talked about the lower volatility. We talked about identifying higher volatility, and that's one way to do it, and we can use that to our advantage. Part of the profit charting functionality is being able to create ratios. So in other words, you can take a look at the SPY, and if you wanted to compare it to the Qs to see which market is stronger, you can do that very easily. Up in this box here, all you have to do is use parentheses and then put in the symbols that you want to measure. For example, let's say we wanted to look at the SPY in relation to, so we're going to put a forward slash mark, the Qs. We want to see which one is stronger. So if we do SPY Q, we can see that if the market, if this is trending downward, that means that the Qs were stronger than the SPY. From September through the current period here, this little period right here in which it was trending higher, means that the SPY it's stronger than the Qs. So what you would do is, if this market is in a downtrend, and you can see that the market actually, it's a little bit, if you do a line chart, it's a little bit easier to tell. If it's in a downtrend, that means the Qs are stronger than the SPY. Trend going down, you want to buy the Qs, because when this trend is, when this market is going down, when you see this graph going down, it means the Qs are outperforming the SPYs. So when it's going down, and now when it looks like it's bottoming, we got a nice little double bottom here. All the same technical analysis tools that you would use on any other market are even better when you're doing ratio trading.